Chapter 19, Not-for-Profit Entities, and Learning Objective 19-1 is to understand financial reporting rules and make basic journal entries for private not-for-profit entities. And then we're going to go into different types of not-for-profit entities today. We're going to talk about colleges and universities, healthcare providers, voluntary health and welfare organizations, and then other not-for-profit entities. And we'll talk about what each type of entity is, examples of each type of entity. For example, what's the difference between healthcare providers and voluntary health and welfare organizations? We'll be talking about what their financial statements look like, and we'll be talking about how they record journal entries. So the following entities are not considered to be not-for-profit organizations because they really just serve a group of owners, members, participants, trust beneficiaries, things like that. So these are accounted for as for-profit, the same way that regular commercial accounting works. Credit unions, mutual banks, employee benefit and pension plans, they follow the accrual method, but they have their own accounting rules. Mutual insurance companies, farms and rural cooperatives, and trusts. And usually for these areas, what you would do is you would look up the specialized accounting for these areas, which are modeled on basic financial accounting GAAP, as we know and love. But there are usually a few different twists on how they record transactions that are unique to those industries. And so some of the characteristics of not-for-profits is that there's no ownership interest at all. These organizations, their mission is to serve users, patients, society, members, but their mission is not to make a profit. And that's really what's key in determining if something is a not-for-profit organization. And they usually depend on contributions. And they usually have some assets that are restricted. And the way restricted assets work is basically a donor donates money to the organization and says, I want you to use this money for, for example, we get scholarships. So the donor will say, I'll donate $100,000 for scholarships. And then that's called a restricted asset because the asset can only be used for one purpose. It's not like cash that's sitting in the bank that the company or the organization can spend however they wish. And then not-for-profit organizations also have something called tax-exempt status. What tax-exempt status confers upon them is it confers upon them the ability to pursue their mission without having to pay any taxes. And Seton Hall is a not-for-profit organization. If you're involved in Beta Alpha Psi, then you may know that Beta Alpha Psi is also a not-for-profit organization and files a Form 990. So when we're talking about not-for-profit organizations, when you compute income, what you would do is you go revenues minus expenses. And so ratios of expenses to revenues, for example, return on expenses would be, return on equity would be net income. Net income is calculated by subtracting expenses from revenues. So that comparison is very important, especially in for-profit companies. But when we're talking about a not-for-profit organization, then the relationship of revenues and expenses is actually completely different, because in a for-profit company, when you spend money, your objective is to produce revenues, to bring in sales. So if you, for example, if you have electricity on in your store and lights, the reason why you have lights on in your store is so customers can see what you have to sell and buy stuff. The reason why you pay employees is so they can sell things to customers. Not-for-profit organizations don't work like this because usually the source of your revenues is completely different from what you spend your expenses on. So, for example, one not-for-profit organization that I did a lot of work with when I worked at Deloitte & Touche was I worked on, believe it or not, they don't call them orphanages anymore, a child care agency. And what it's not child care exactly, it foster care, group homes, things like that, all sorts of different services that this organization provided to children who, for one reason or another, did not live with parents and needed some alternative support. So the expenses went to support these children. The revenues came from donors. It came from income on an endowment fund. And it also came from the government. So the source of your revenues, I mean, you do spend money in order to bring in revenues, but they're much more separate because the money that you spend is going to whomever is going towards your mission. And then the revenues are coming from a completely different group of people who might not be benefiting from your mission at all, but they want to help you do it. So there's no goal here to maximize return on ownership interest. In fact, ownership interest really is just an indication of how solvent your organization is and how solvent and liquid you are. And non-governmental not-for-profits are accounted for, the rules come from the FASB, but governmental not-for-profit organizations, and we'll talk about what those are in a moment, come from the GASB. So there are some non-profit entities that are linked to the government, and therefore they're treated more like governmental entities. We'll talk about them when we talk about public colleges, are the big one. Public colleges and universities. So private not-for-profit entities are going to follow ASC 958 and its subsection 205. And they have three major financial statements, as you almost always have. The statement of financial position, which is like a balance sheet, the statement of activities, which is like an income statement, and the statement of cash flows. And again, when I say income statement, I'm got to be very careful here. What I'm referring to is a statement of flows. Really, we like to call it a P&L, and inside the business, we like to call it a P&L. But there's no profit here because your goal is not to make a profit. So you kind of have an excess of revenues over expenses, but we're never going to call it profit, and that's why we can't call it an income statement. And ASC 958, Section 210, created a new system, and it's very new. I think it was released in 2016, of breaking net assets into two different categories. There used to be three, and now there are only two. So these categories are net assets without donor restriction and net assets with donor restriction. So net assets without donor restriction means that you can do whatever you want. The organization can do whatever it wants with these assets. But sometimes donors give the organization some assets, and they say this is for this or this is for that. Whenever you have some kind of donor restriction, that asset needs to be categorized into the group net assets with donor restrictions. So these two sections of net assets, they're not using the term fund here, but this system is identical to the fund accounting system we saw with governmental accounting. It's just that we would set this up with two funds. And in fact, what you could do is you could have multiple sets of net assets with donor restrictions, depending on what the donor restrictions are. So for example, you could have a scholarship fund, you could have an endowment fund because you can spend the income but not the income but not the asset, and things like that. And donor restrictions can be short-term, long-term. There used to be a distinction between temporary restrictions and what they just call regular restrictions, and we don't have that anymore. But rather, either it's restricted or it's not restricted. And you need to explain what the restrictions are in the notes to the financial statements. So it makes sense here to use a fund structure. Some organizations rather will skip that entirely. Oftentimes they might not have many restricted net assets, or I should say net assets with donor restrictions. So sometimes they may not have many restrictions at all, so they're just going to keep a set of books like any regular company. But usually it makes sense to use a fund structure, especially if there are a lot of transactions. And each asset, you need to keep track of every donor restriction. So any asset that you have that has a donor restriction, you need to keep track of that asset carefully and make sure that the donor restriction is recorded and that it's not accidentally used for something that's a violation of the donor restriction. Because if you do that, that would be a violation of your fiduciary duties, and it could be called fraud. So let's talk briefly about contributions. Contributions consist of cash, other assets, or what's called a pledge. This is a promise to give. And contributions of services are recognized as other, believe it or not. They're not quite other assets, but they need to be recorded under two conditions, all right? This is very tricky. If they create or enhance non-financial assets, or if they require specialized skills. They're provided by individuals who have those skills, and if they weren't donated, you would probably need to purchase them. So for example, if a doctor agrees to do work in your hospital for free, that would actually be recorded as a contribution. On the other hand, if a high school student came into the hospital to volunteer and to help, talk to patients and, sort of be a gopher and bring coffee to people and things like that, which people sometimes do in a hospital, that would not be a contribution because it doesn't require specialized services. If a contractor came in and said, we'll do this for you, we're going to do a little construction work for you, that would be a contribution. Not only does it require specialized skills, but it also enhances other non-financial assets. So these are recorded at fair market value. And ASC 958 also has guidance on depreciation, investments, accounting for general contributions, and these were created to be as similar as possible to for-profit companies. Now, accounting for depreciation is recorded similar to a for-profit company. So this is going to seem very similar here. Depreciation must be shown for long-lived tangible assets other than works of art or historical treasures that have value worth preserving perpetually and whose holders have an ability to preserve that value and are doing so. So even though you plan to hold something forever, you still need to depreciate it, and it would be recorded as an expense. Now, if something is a work of art or what's considered to be a historical treasure, and this could be a museum as an example, because a museum would be typically a not-for-profit organization, then that probably doesn't need to be depreciated. It may need to be tested for impairment under certain circumstances. So you would need to disclose the depreciation for the period, the total of each class of assets, the accumulated depreciation, and how you compute depreciation. That is same as for profit. Fair value should be the measurement basis for investments in all debt securities, equity securities. Debt securities are valued at fair value. Investment income comes from interest and dividends, same as regular companies. And investment income is reported as a change in net assets without restrictions. That's provided that there's no restrictions. You could have an investment where the donor restricted the income from the investment. I suppose that could happen, in which, that does happen, and then it would be restricted by donor. And contributions are recorded always at fair value. And they're recognized as revenues or gains in the period pledged. And they would be reported as support with restrictions or support without restrictions, depending on if there were any restrictions. So a donor could just give you $1,000 and say, here, use this for your organization. Or they could say, here's $1,000. I want you to use this for this purpose only. So when they give that donation, then it's a contribution. So again, services would be recorded as revenue. if they create or enhance non-financial assets, they require specialized skills provided by individuals who possess those skills and typically need to be purchased if they weren't donated. So those requirements here, this is really something that you want to know for the CPA exam. That's a CPA exam question. And there are three parties to a contribution process. There's a donor, there's the recipient organization, and there's what's called the beneficiary. And the recipient organization is your organization that's taking the assets, receiving these assets from the donor. It could be cash, it could be physical assets. The beneficiary is whoever is going to ultimately benefit from this asset. And what many not-for-profit private colleges and universities, a lot of other really not-for-profit organizations will sometimes do is they'll have something called a foundation. And the foundation's main purpose is just to raise money. And what the foundation will do is it will work hard to raise money, and then it will distribute that income or a portion of the income back to the main organization. And the slide here says not-for-profit private colleges and universities, but this is really, hospitals do the same thing. They'll have what's called a foundation. And oftentimes the foundation will have a separate board from the hospital. And this is a really good move because the board of the foundation is going to be focused on fundraising, and the board of the hospital is going to be focused on treating sick people. And you don't necessarily want the same board. You don't necessarily want one board raising money and treating sick people. Same thing in a university. The board of the university is going to be more focused on education, we hope, while the foundation is going to be more focused on raising money. So this is a common tool, and these could be completely separate organizations, and sometimes they may consolidate, and sometimes they may not, depending on the conditions, depending on their relationship. Now, with mergers and acquisitions, it says here they should account for the merger using the carryover method. So what they would typically do is it would be pretty much the same. This means it's a little different from what we've seen before. I just said it's the same, but it's a little different. It's a little different in that the carryover method says you can pretty much combine the two sets of financial statements together. So you don't necessarily have one organization that's buying the other because they're not for profit anyway. And therefore you wouldn't mark the subsidiaries' financial statements to market value, but rather you would continue using the same values on the income statement. But what you would need to do is that if there were some situations where you were using different accounting standards, then you would need to adjust the numbers to all reflect consistent accounting standards. So things like depreciation methods would need to be adjusted. And here are the ASC sections, and it requires goodwill, other intangible assets to be assigned to reporting units that are required, because you may still have goodwill in that situation, depending on the arrangement. So let's look at some basic journal entries in a not-for-profit organization. Charles Alt makes a donation to a not-for-profit organization to be used specifically for a research program. So this would go into your set of net assets with donor restrictions, and this is like a fund. And you debit cash and credit contribution revenue for $40,000. And now let's suppose that your research program expenses, which Charles Alt gave you the donation for, have been approved, and you're having those expenses and you're getting ready to pay them. So the debit is going to be, this is going to be a long one, you ready? Is reclassification from with donor restriction net assets satisfaction of program restriction. And you're going to credit cash. So the cash now is going to come out of this fund and it's going to go into net assets without donor restrictions. So then you'll debit cash in there because they're going to get this cash. And the credit, again, is a mouthful. It's reclassification into without donor restrictions, because that's the other category. There's with donor restrictions and without donor restrictions, net assets. Satisfaction of program restriction. Like so. And then what you've got to do, of course, is actually pay the expense. And that would be whatever the expense is. Let's just say expenses here. And credit cash. Like so. So that's how donor restrictions are going to be handled.